Okay, it is 3 minutes past. We can go ahead and start the webinar. What we are going to be talking about today is how good is your bookkeeping? So goals for today, number one, why do we need clean and accurate books? Why is that important? How do we know if our books are clean and accurate? Where and how to look and see if your books are clean and accurate. Number four, it's a little bit of a QuickBooks Online tutorial, a little bit. And then number five, we'll get to questions if time allows. So if you have any questions during the webinar, by all means, please do use the Q&A function inside of Zoom. Happy to answer those either in real time or at the end of the session. This is the obligatory disclaimer. Basically what this says is that we are not giving specific accounting advice. Your situation may be different than the situations that we talk about in the webinar, and you cannot rely on this for any reason. It is for informational purposes only. So a little bit about us. My name is Chris Servishon. I am the owner of our CPA firm. We have a team of 7. The other members you see are on the screen. We've got a total of 4 accountants and 3 admin/support staff, and we are geographically diverse. We've got team members who are international, and we're all across the country as well, as are our clients as well. So jumping right into it, why are the books important? And the books meaning your accounting data, for 2 reasons. Number one is compliance. Generally speaking, when we're talking about compliance, we're talking about filing a tax return, but there are other reasons why you may need to have compliant books or things that you need to be in compliance with. Not the least of which would be some sort of bank reporting. Maybe you have bank covenants that you need to be in compliance with. Maybe you need to be submitting reports to the bank on some sort of basis because you've got a loan with them or something like that. But most commonly what we see is a tax return. So that's number one. Number two, which is the most interesting part, is so that you can ask questions about your business and then get accurate, timely, reliable responses back, which will allow you to make strategic decisions. When we're making strategic decisions, what we don't want to be doing is making decisions based on bad data. If we're making decisions based on bad data, even if the decision is great, it went through the process, you made a good decision, it could still turn out wrong because you're relying on faulty assumptions. We don't want to do that. What we're in the business of is providing advisory services. So when we're providing advisory services, we want to have good, clean data so we can provide accurate information, accurate advice, timely advice, and you can't do that with poor or inaccurate information, and certainly not with information that is not timely, put it that way. So the 10 review points and where to look. This is basically a checklist. So number one, COA descriptions. What does COA mean? COA means chart of accounts. What the chart of accounts is basically the buckets where you classify transactions inside of your accounting software. Number one. Number two, make sure that your bank and credit cards are reconciled. Number three, do a balance sheet sanity check. And then the balance sheet is where the bodies are buried. If there are problems with the books, you're going to see them on the balance sheet. The problem is to get things off of the balance sheet, generally, you're going to have to impact the P&L. The P&L is most commonly where people, business owners, are managing their business from. We see most commonly business owners are looking at the P&L to kind of judge how they're doing. Very rarely do they actually look at the balance sheet. But you have to understand, if your balance sheet's a hot mess and you're making decisions based on what the P&L looks like, and you think the P&L is great, but the balance sheet's a mess, your P&L is wrong. It's got to be. So to fix it, you have to get things off of the balance sheet. You got to run them through the P&L. Creates a whole mess. So that's number three. Number four, clearing accounts clear, and we'll go through that in a little bit. Unreconciled transactions, you want to make sure that every transaction that runs at least through a bank or credit card account is reconciled. Number six, expenses have vendors. Number seven, the vendor classification is consistent. Number eight, material activity in GL accounts, and we'll talk about what materiality really means. Number nine, payments before invoices. So in other words, if you're going to get paid for an invoice, the payment probably needs to come after the invoice, just from a date time perspective. Doesn't make any sense that you get paid and then you send out an invoice. That generally doesn't happen. It's not the way the business happens. What that's really referring to is it's probably a misapplied payment that creates issues. We'll talk about that a little bit too. And then number 10, uncategorized and miscellaneous. What does that even mean? That's the problem when you have things that are in uncategorized accounts or miscellaneous accounts. There's no detail. It's not informative. You can't make decisions based on miscellaneous. Really shouldn't have those. So that is the list. What we're going to do is we're going to hop into QuickBooks. And this is our demo company account. This is not real data. It's fake data. So I'm not showing you anything that's proprietary, but we're basically just going to go through the set of examples. We're going to run down the checklist. I'm going to show you exactly how to find what I'm talking about. So this is your dashboard. Probably looks a lot like this. When you go to the gear icon, you're going to go to chart of accounts. Now, what this is a listing of all the various accounts that exist in your accounting system or accounting process. So we've got a barter account, we've got our business checking account, savings account, so on and so forth. These are where you can classify transactions to. What you want to do is you want to open up these accounts on occasion, and you want to see a description. So why is that important? That really gets into completeness. So when you go in and you're thinking, okay, like what is a barter account exactly? The description should tell you. So if you ever come across a transaction, you're like, I don't know what this is, and I'm not sure where it should go. I'm not sure what account is appropriate. You can go through the chart of accounts and you can figure out, okay, well, this seems to match, the description of this account seems to match the transaction. The activity should probably get classified in this account. Cool, we're good. It also sets expectations. So you should have a reasonable expectation by account of what activity or what type of activity should go in there and what you should see. And that should be consistent. So we want to make sure that there's a description in every single account. This is the way to check it. So it's more of a completeness thing and an auditability thing, if I really had to kind of distill that down. So that's the first one. Go through the chart of accounts, make sure that there's an account listed for make sure there's a description listed for every single account. There's also another way to get to that. So you can go actually into the reports, and there is a report in here, which is called account list right here. So generally accountants have access to this. Generally the business owner will not. So if you're using an accountant or a bookkeeper or whatever, ask them to go pull that report, take a look at the description. You can see in this chart of accounts, there's like very few descriptions. That's not good. I would say that this is an incomplete chart of accounts at best. So again, completeness, that's the big thing. All right, so that's that. So that's number one. Number two, make sure the bank and credit cards are reconciled. Now, what does that mean? Well, in historical parlance, what we would call that is balancing your checkbook. It's a reconciliation. So what we're doing is we're making sure that everything that's running through the bank and the credit card accounts is in the accounting system, and things that are not running through the bank and credit card accounts are not in the accounting system. So again, we're going to go back to the gear icon. We're going to go to reconcile. And what we want is the link up here at the top right, history by account. So we're looking at our business checking account. That's this account right here. And you can see, actually I reconciled these today. So that's today's date when we're recording this. And you can see it's been reconciled through December, November, October, so on and so forth. What we should see when we open this report is that the account is being reconciled on a continuous basis at some sort of a cadence, probably at the end of the month or a couple of days thereafter. We should also see in this changes column that there are no changes. So basically what that means is we reconcile the account and then somebody went in and changed a historical transaction and now the account is not reconciled anymore. That's not a good thing. So we can see here, super clean, no changes, totally reconciled. That's a good thing, right? Well, that's the checking account. What happens if we go to the savings account? Nothing. Okay, so that account's not reconciled. And then if we go down to the credit card account, this is the business credit card, that's not reconciled either. So we've got a problem. So we haven't reconciled all the accounts. So we don't know if our books are accurate. We can't even start to begin that process because there's a whole bunch of activity that's flown through here that it's never been reconciled. We've never checked it back to the bank statement. We've never done any of that research. So that's a problem. So that's number two. At a bare minimum, you want to make sure that all of the bank and credit card accounts, bank and credit card type accounts are reconciled on a continuous basis, and that we're not seeing any changes in that changes column. Super important. That's like bookkeeping 101, I would say. So that's the second thing. Number three, do a balance sheet sanity check. So the balance sheet is where all of the bodies get buried. Accounting at its heart is really no more complicated than a algebraic equation. So debits have to equal credits. Accounting has two sides to each entry. There's only two posting financial statements, the P&L and the balance sheet. So when you're classifying transactions, it's going to impact one or the other. Okay. So if the balance sheet is wrong because it's a two-sided equation, that means the P&L has got to be wrong. So we need to make sure that the balance sheet is correct, and we have to do sanity checks every once in a while. So what we're looking at right here is a balance sheet that's monthly for the last 7 months. So it goes back to July 2022. All that we're looking for here is like a sanity check. So when we look at the business checking account, like, do we think that we have $2 million? When I'm looking at this number right here, do we think that we have $2 million in the bank account? Does that seem legit? You're the business owner. You should probably know. You probably have a sense. If the answer is no, well, then it doesn't make sense. We have to ask a question. Now, accounts receivable in November, we have a negative amount. We should rarely, if ever, see negative amounts in a financial statement. Rarely. The only exception really is contra accounts and discounts. So a contra account is an account that goes with another account. It gets paired with another account. Your best example of that is accumulated depreciation. So accumulated depreciation, that's a negative $144,000. Our computer equipment is $146,000. So our net asset is $2,000. Basically, the accumulated depreciation is just reducing that equipment account. So instead of running all that activity through the equipment account, we're showing it in two parts. Basically, that's a contra account. We should rarely see accounts receivable or like be negative. Negative accounts receivable is really accounts payable. So what that's saying right there is that you owed somebody $135,000. That's not an asset. That's a liability. So it's in the wrong spot. It's the wrong type of activity. It doesn't make any sense. Now, when we look at the liabilities and equity side, which is going to be the bottom section of the balance sheet, the bottom half of the balance sheet, it doesn't make sense that we have a line of credit outstanding for $200,000. I don't know, but you're the business owner. You probably have a sense of that. Doesn't make sense. If it doesn't make sense, ask a question, do some research. Ask the accountant. $70,000 for a business line of credit. Does that make sense? Or a business credit card, I mean. Don't know. Again, ask the question, do the investigation. So that's what we mean when we're doing a sanity check. Does everything seem to make sense? So that was number 3 on our list. Number 4 on our list is clearing accounts should clear. So what is a clearing account? The best example and the most common example is right here, this undeposited funds account. So basically what a clearing account is it goes to zero on some sort of a periodic basis. It's like a holding account. So undeposited funds, basically what that means is somebody gave you a check and you deposited it and it's in transit. It hasn't hit the bank account quite yet. And so you would see a balance here. And then when it hits the bank account, you would see the balance go to zero. And then you would see the increase happen in the checking account or the savings account or whatever. Again, accounting is a two-sided thing, two sides to every single entry. So if a clearing account isn't zero, or if it doesn't go to zero, that is a problem. That means that there's activity in there that shouldn't be in there. So this is all of the transactions that are running through undeposited funds. You can see that they are very old. And what we look at when we do this investigation is the balance. You can see the balance is positive, it's negative, 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 and it moves around, right? What we saw on the balance sheet though, was that balance was going to zero. So we'll see at the end of the period when we last had activity, which is December of 2018, this balance is now zero, cleared out. That's a good thing. If it doesn't clear, if it never clears, that's not a good thing. That's when you need to start asking questions. And that can happen for a number of reasons. There's not one set reason why clearing accounts don't work or why there's improper activity there. So it requires quite a bit of investigation. So that's clearing accounts. So number 5, unreconciled transactions. Now, what's interesting is I showed you a couple minutes ago that the reconciliations for this business were clean. They looked really, really good, right? Well, not so fast. Here's what you want to do. You want to go into the actual activity for the account. And so here's all the activity going back to July of 2022. And then over here on the right, there's a little gear icon. Click that. And what we want is we want to show the clear column, CLR. Click out of that and it'll give me a new column here over to the right. And you'll see in here, all of these have R's next to it. And what that means is that that transaction has been reconciled. Okay. Now what happens when we go all the way to the bottom? So you'll see some that have a C. C basically means it's cleared. What cleared means is that it actually came directly through the bank feed in QuickBooks. In other words, we know it's a known transaction that happened at the bank. It just hasn't been reconciled yet. But what's interesting is this transaction right here, this $10,000. There's no R, there's no C. It's for Adobe. It's 10,000 bucks, and it happened on the 15th of December. So how does that happen? When you go and you reconcile the accounts, you check off all the transactions that are on the bank statement, and then there may be some that are left over. That's what happened here. So this is a transaction that didn't go through the bank. It doesn't belong in the financials, and it's an extra expense. So the net effect of it, and imagine that you have tons of these, and we've seen this. So what actually happens is this is an expense. And so net income is now lower than it should be. And when we go to file a tax return, net income is lower than it should be. So you didn't pay enough tax. And now we have to go and we got to make some adjustments, do an amendment. It's a messy process and it can be very costly. Think of it the other way. If you have income that you never actually did the work for and never actually received cash for, now your net income is overstated. We've seen this before where clients actually have a massive multi-$1,000 tax liability just because of bad bookkeeping, right? And the way that it happens is that you can actually reconcile an account and not all of the transactions be reconciled. And that's what this is showing right here. So you have to look at the reconciliation report, and then you have to go to the next step and look at all of the transactions individually and make sure that they have been reconciled. That's probably one of the biggest bookkeeping problems that we see, and it's definitely one of the most costly. So that's unreconciled transactions. Number 6, every expense should have a vendor. So when we go back to reports, we're going to run the expenses by vendor summary. And let's just do it for all dates. And then what we're going to do is we're going to scroll to the very, very bottom. This not specified amount right here. So we've got $7 million of transactions in the books here that don't have a vendor associated with it. They don't have USPS, they don't have UPS, so on and so forth. Why is that a problem? It's a problem when you go to do the budget or when you're having financial difficulty and you're trying to decide what expenses to cut. Because when you run this report, you can't get a sense of where your money is actually going. You can get a sense by GL account, but you can't get a sense by vendor. And the vendors are really what you have to cut. So either you need to go back to a vendor and say, hey, we need to reduce our pricing, or we need a different relationship, or we're going to move to a different vendor, whatever it is. If not every expense transaction has a vendor associated with it, it makes it really difficult to do that analysis. Super important. You shouldn't see not specified hardly at all in your books. The one exception generally is where we see with payroll transactions when they come through. And that's a whole different animal. It's another conversation for another day. But that's most commonly when we see that it is appropriate, but in most cases, it's absolutely not. If we go and we open this, you'll see all of the activity like Amazon Web Services, Amazon Web Services. These are expenses. Like, should we even be paying for these? I don't know. Maybe, but we can't do that analysis because, we just don't have the data that we need. So that's that. Next up on the list is vendor classification consistency. And basically what this gets into is we just want to have accurate books. So when we open up the vendor card for Amazon Web Services, didn't go the right way. I'm going to go over here to get paid and pay. And then what we want are vendors. I'm just going to pull a random vendor. So Adobe. Basically what we're looking for is that the account, the category that it's going to is the same every single time. There are exceptions to that rule. Google is a great example, especially for marketing and creative agencies. You can pay Google for G Suite. You can pay Google for ads. Those are different types of transactions for different purposes. Same vendor though, but you just want to do a sanity check. Like, should this vendor be going to this type of categorization? Does it make sense? Is this the way that our business actually operates? So that's the consistency. Material activity and GL accounts. This is one of my favorites. We're going to go to the profit and loss statement. And we're going to pull this by month. And we're going to go back to July again. Basically, materiality, what does that mean? It means that it is a substantive transaction. So what does that mean? Why is that important? What we see most commonly is that folks who DIY their own bookkeeping, they will open a chart of accounts. So like advertising and marketing internal, and they'll open an account for every little thing. And is that appropriate? Maybe. Is it? Maybe, maybe not. Who knows? But we want to make sure that materiality thresholds are at least considered. So this business is doing like $400,000 in revenue per month. We shouldn't have an account, and I'll try to find one here. Like computer repairs. How often is that actually happening? Like not every month, but a little bit. If this transaction was $30 and $50 or whatever, $30 or $50 in the context of 200,000 is not important. It's just clutter. It's financial clutter is what it is. So what we really want to see, we want to see accounts that are open that have transactions in most, if not all months, and the dollars that are running through there are material. In other words, you need to make a decision on that dollar amount, or could make a decision on that dollar amount. If you can't, if it's insignificant, if it doesn't matter, if it's $30 a month on $200,000 in revenue, nobody cares. Consolidate that activity into another account. So basically what that means is that's what that means. We want to get rid of financial clutter as much as we possibly can. All right, payments before invoices, and then uncategorized and miscellaneous. So while we're on the P&L, I want to talk about uncategorized and miscellaneous. So you'll notice here, and this goes in alphabetical order, we don't have an uncategorized account, and we don't have a miscellaneous account. Uncategorized and miscellaneous accounts, again, that's clutter. When we have a bunch of transactions that are going through miscellaneous, well, what does miscellaneous mean? Nobody knows. There should rarely, if ever, be a transaction in uncategorized or miscellaneous or anything labeled as such. Like we know what phone and internet is. We know what it's for. We know what postage and shipping is. We know what it's for. We have no idea what uncategorized means. None. We don't even know what miscellaneous means. So keep activity out of that account. And then the last one, we're going to go back to reports. And there is a report that is in QuickBooks. It's called Invoices and Received Payments. So we're going to go ahead and pull this again for the last few months. And what we should see, we see an invoice, or we see a payment rather, on December 16th. And it's for invoices that were sent between 11/16 and 12/16 of the prior year. So this payment date is after the invoice date. That makes logical sense. We've got another one here, Brewery International. This payment date is after this invoice date. This payment date is after this invoice date. It's important to review these at least on some sort of a cadence, because if we have payments that are coming before invoices, that is an indicator. It's not always the case, but it's an indicator that that payment was misapplied to an invoice. Why is that important? Because when you go to your customer and you say, you owe us for invoice 1 and invoice 3 and invoice 5, and they say, no, we paid 3 and we paid 5, this could be the source of that. And it makes for a very uncomfortable conversation with your customer. It makes it seem like you don't know what you're doing. It makes you seem disorganized. That starts to erode away the trust that you have with that customer relationship. Not a good thing. And it all stems from poor bookkeeping. It happens. We've seen it. It happens all the time, actually. So that is also an important point to look at. So that is the bookkeeping checklist. Additional resources that are available, and there are a ton, and they're all free on the website. There is an ebook called From Freelancer to Agency. There is a webinar that's out there. It's evergreen. You can go watch it. It's called the Agency Profitability Audit Framework. We did that at the end of last year. There's a webinar and an ebook for how to recession-proof your agency as we're recording this right now. That is top of mind for a lot of agency owners. Number 4, Scaling the Data-Driven Agency ebook. So that expands a little bit on some of the ideas that we've talked about in this webinar, which is how do you use the financial data that is inside of your agency or inside of your business in order to scale. Hopefully some of the examples resonate that I've given over the last half hour or so. And then number 5, the Cash Flow 101 webinar. Cash flow is such a big topic. So too long, didn't listen. How good is your accounting? It's important because number 1, you need to file an accurate tax return and you need to be in compliance with whatever it is that you need to comply with. Other examples would be a bank covenants, things like that. Number 2, good financial data helps you to make strategic decisions. You don't want to make strategic decisions based on bad data. That nothing good comes from that. And then number two, there's a list of things that you can check inside of your books. I showed you how to find those things. You can do it. I mean, you saw me do it in probably 20, 25 minutes or less. Certainly you can do that in your business as well. That will help to inform you of the questions that you need to ask and whether or not your accounting is working for you and whether or not you're using good data to make the decisions that you're making inside of your business. So with that, I will see if we have any questions. No questions, so we can hang out for it. There's one. Okay. So 3 questions that you can ask your bookkeeper to verify that your books are clean. Number 1, when was the last time you updated the books? Number 2 would be, what is your reconciliation schedule? And I'd also take that a step further, like 2A would be, what accounts on the balance sheet are you reconciling? We only reconcile the balance sheet. We don't reconcile the P&L. The balance sheet has balances. The P&L has activity. Those are very different things. Probably another topic for another webinar. And then number 3 would be, I would just ask for a walkthrough. Like, walk me through the books and explain what's going on. And a good bookkeeper who's down in the details, or a good accountant, even good accountant, a good bookkeeper who's down in the details, understands the business, understands the transactions that are flowing through there, should be able to walk you through step by step and tell you the story. If they can't do it, that means they probably don't understand what exactly it is that they're doing and what their function is within the accounting process and the accounting procedure. But great question. Okay. Don't see any more. I definitely appreciate everybody's time and attention, and thanks for joining our webinar. We will see you next month with another new topic, and that's it.